This morning we have a special guest in Grant Cullens, and I'll be introducing him shortly, and he's going to be giving us an investment and economic update. But before we do that, I'm going to just give a bit of an update on the budget. Sorry, I didn't introduce myself. My name's Craig Ayling. I'm the Financial Planning Director at Fortunity, if I haven't had the opportunity to meet you yet. And so I'm going to be running through just a bit of an update on the budget this morning. When we first planned this morning's seminar, we were thinking of having the whole thing as a budget update. We did change our minds before the budget was handed down, and we're very grateful for that, because I don't think we could have actually spoken for an hour about the budget. There were a number of announcements, but certainly it was a bit light on compared to some previous years where you could certainly talk for an hour or two maybe on all the changes that were coming through. So a bit light on this year. But sometimes that's a good thing. So we'll run through some of the changes and then we'll hand over to Grant for the investment and economic update. So that's the Julia and Wayne team trying to get back into surplus. They've got a bit of a job ahead of them. But just some of the headline numbers. We often do concentrate on the actual announcements in the budget and the changes and what's going to happen to tax, superannuation and so on. But obviously the budget is primarily a budget where they're trying to balance the books. And so the numbers that we're looking at this year is a projected deficit of $22.6 billion. If you say that fast, it doesn't seem quite as large a number as it actually is, but it's a fair few dollars there. Looking to return to surplus with a surplus of $3.5 billion by 2012-13. That's a fairly big turnaround, isn't it? A $26 billion turnaround in 12 months. So whether they're able to pull that off or not, I'm not sure. And they probably won't know either, because I did notice that there was actually a $5 billion change in the revenue, the projected revenue between the estimates they made in November and the figures that they discussed in last week with the May budget. So tax receipts can change quite dramatically, quite quickly. So you do all the budgeting, and then your revenue can be out by as much as $5 billion in that time period. The budget included new spending initiatives of over $23 billion, offset by tax or by savings or reduction in spending of $22 billion. So fairly much line ball there. And an interesting number I thought was the fact that the total tax receipts $350 billion. So quite a large number again. I'm not sure how much you can see of those numbers. It's probably not a whole lot, but just a good graph showing where the revenue comes from compared to where the money's spent. And the biggest tax take is from individuals' income tax, which is $150 billion. Comes around company, and the existing petroleum tax is the next biggest, and then the other chunks including sales tax, super, customs, fringe benefits and so on. On the other side we've got the biggest chunk going to social security and welfare, so we won't open that discussion and see whether we think that's worthwhile. General government services, not entirely sure what that is. I suspect that's a lot of people in Canberra. And then health, education, defence and so on in the smaller chunks. But $350 billion, it's a little larger than my family budget. Okay, so on to the announcements. The main areas were some superannuation and tax announcements, and a couple on social security as well. So one of the main superannuation changes is about excess contributions tax. Now, I'm not sure if you saw this particular article or a number of articles around the time about 6 weeks ago. It was highlighted about how ridiculous a particular piece of tax legislation is, that if you make additional contributions to your super fund over the limit, then the tax rate can be extremely onerous. So the theoretical tax rate is 93% of the excess contribution. So you've got a limit that you're allowed to contribute. If you contribute over that, it can be up to 93%. The trouble is, the way the rules work, if you have contributed over on the tax deductible contributions and then also maximised your personal contributions, it can trigger a number of things. And in this particular example that's spoken about in this article, someone made a mistake of $10.30. So instead of making a $50,000 contribution in the year, they made $50,030.10. It wasn't even their fault. Their employer made a different level of contribution than what they said they would, and the tax assessment they got was $69,754. Now, they're appealing that assessment, as you might well imagine. I haven't heard whether it's been successful or not, but yeah, a $10 mistake and $69,000 penalty. Now, I think that comes into the category of unintended consequences of the legislation, but I think they need to get some new legislation drafters in Canberra. But that is an extreme example, but a lot of people, some 165,000 people last year were issued with assessment notices on excess contributions tax. What they've done is they've made a change, and that is there's a one-off opportunity to have that excess contribution refunded, only if it's up to $10,000. So they have seen the light a little bit there. It's going to be taxed personally as income rather than as penalty tax. But as is the case with many announcements at budget time, they announce the headline, and then once you start to look at it, you sort of think, oh, what's the detail? There's still a few things that are unclear, and they include such things as will the amount be refunded, will the refunded amount be taxable back into the fund? Will the refunded amount be counted towards the non-concessional cap? So this is talking, these excess contributions are talking about your tax deductible contributions, so your employer or your business contributions. So if you have gone over that limit, will they then be counted towards your personal contribution cap? And what happens if you make a $10,001 mistake? Are you back into the old regime? They haven't made announcements on those issues yet. The actual caps or the limits are changing as well. So not that many years ago, you might recall that you were able to make a $100,000 contribution into super if you were over 50. It went down 2007 to $50,000, and now from 2012 it's going down to $25,000. However, if your superannuation balance is less than $500,000, then you get an additional $25,000 cap. So it will effectively be $50,000 or even a little more once the actual threshold, the $25,000, is indexed periodically. However, still a couple of things that are unclear, and the main one is how and when is that $500,000 going to be measured. And there's been a few things mooted there. You know, the 1st of July of that financial year, 1st of July of the previous financial year. There's also issues such as what if you're on a transition to retirement pension and you've actually started to withdraw money from your super fund. Are you allowed to have the extra cap? If you are, how does that work? So there's a number of issues there that they've yet to work through. A couple of other superannuation changes. The co-contribution, if you're making a small personal contribution to get the government co-contribution, there are income thresholds and they've been frozen for another year. I'm sure you've also seen one other thing that was frozen. That was access to some benefits that was frozen at $150,000 worth of income, and that whole debate that then ensued as to whether someone on $150,000 was rich or not. So I think I lost count of the number of articles I saw in the press around budget time about that. Also for the employers in the room, you have to start actually showing your superannuation contributions for your employees on your pay slips, and also super funds are going to be required to notify members if regular contributions stop. So the idea there, of course, is to catch those employers that when things are a little bit tight, they still make your fortnightly pay, but the first thing to drop apart from that, after the tax office usually, is superannuation contributions. For those on pension, and I know there's a few in the room that are on allocated pensions, so as you're aware, over the last couple of years, we've only had to draw half of the standard minimum pension. So if you're under 65, you had to draw 4% normally, and over the last couple of years, we've only had to draw 2% pension. So that was a transition measure in response to the GFC, when people said, well, if I don't have to take this pension, why do I have to sell assets to actually just meet a minimum that I don't need? So they halved it for a period of time, and now from next year, that's gone from a half concession to a 25% concession. So in other words, you need to draw 75% of the normal pension. So if you're under 65, that's going to be 3% rather than 4%, and then it'll go back to the 4% in 2012-13. Also, I thought just for the more aged members in the room, I just put all the thresholds there down to the 95s and over. So if that applies to you, well done for getting out this morning. So a couple of tax measures that have been announced as well. If you're distributing income to your minor children from your family trust, then no longer will they get the low income tax rebate. Effectively means the tax threshold for minors is being reduced for unearned income, so things like trust distribution or interest income, from $3,000 odd to $416. Also, a couple of other things: phasing out of the dependent spouse rebate for those those spouses that are under 40. So if you've got the new young wife, there's a problem there for you. And also, if you're supporting your kids and helping them with some HECS repayments, there's some changes to that as well. One of the other announcements was about fringe benefits tax for cars. So if you're driving between 15 and 25,000 kilometres a year, there's no change. But if you're driving more than 25,000 kilometres, then there's a gradual increase in the fringe benefits tax rate there. So I think they decided that encouraging people to drive further to get a bigger tax deduction wasn't actually environmentally sound. So I think that was the main thing behind that change. Okay, just a couple of changes on Social Security. So Family Tax Benefit B, quite a few changes there, mainly to assist those that have children in full-time study between 16 and 19. Also the ability to do some part-time work for those on disability support pensions and still be eligible for a part pension, and various other measures to encourage people that are on government benefits to to increase their workforce participation. So when we saw that slide with the big chunk of the budget that's going towards Social Security, obviously they are trying to reduce that a little bit. Okay, so we do have the privilege of having Grant Cullens with us this morning.